Section 1:1 Introduction to Modern Portfolio Theory. Overview of Modern Portfolio Theory. Modern Portfolio Theory, MPT, is a framework for portfolio management that was developed by Harry Markowitz in the 1950s. It is a cornerstone of investment theory and has had a significant impact on the field of finance. The main goal of MPT is to maximize portfolio returns for a given level of risk or minimize portfolio risk for a given level of return. Here are some key aspects and the significance of MPT in portfolio management. Diversification. MPT emphasizes the importance of diversification in constructing portfolios. Diversification involves spreading investments across different asset classes, such as stocks, bonds, and commodities, as well as within each asset class. By diversifying, investors can reduce the overall risk of their portfolio without sacrificing potential returns. MPT provides a mathematical framework for determining the optimal asset allocation to achieve the desired level of diversification. Risk and return trade-off. MPT recognizes that there is a trade-off between risk and return. Higher returns generally come with higher levels of risk. MPT helps investors find the optimal balance between risk and return by considering the risk and return characteristics of individual assets as well as their correlations with each other. It allows investors to construct portfolios that provide the highest expected return for a given level of risk or the lowest level of risk for a given expected return. Efficient frontier. MPT introduces the concept of the efficient frontier, which is a set of optimal portfolios that offer the highest expected return for a given level of risk or the lowest level of risk for a given expected return. The efficient frontier is derived by plotting different combinations of asset allocations and calculating their risk-return profiles. MPT helps investors identify portfolios that lie on the efficient frontier and make informed decisions about their risk and return objectives. Quantitative analysis. MPT relies on quantitative analysis and statistical techniques to assess the risk and return characteristics of assets. It considers parameters such as expected returns, standard deviations, a measure of risk, correlations, and variances. By using these parameters, MPT enables investors to calculate portfolio statistics, such as expected portfolio returns and portfolio risk, and make data-driven investment decisions. Foundation for other portfolio management strategies. MPT serves as a foundation for various other portfolio management strategies, such as asset allocation, factor investing, and risk parity. These strategies build upon the principles of MPT and provide more advanced techniques for portfolio construction and management. In summary, MPT is significant in portfolio management as it provides a systematic framework for constructing diversified portfolios that balance risk and return. It helps investors make informed decisions based on quantitative analysis and optimize their portfolio allocations to achieve their investment objectives. MPT has become a fundamental tool for investment professionals and has greatly influenced the field of finance. The historical context and development of modern portfolio theory, MPT, can be traced back to the early 1950s when Harry Markowitz, an American economist, developed the theory. Markowitz's work revolutionized the field of portfolio management by introducing a quantitative framework for portfolio analysis. During that time, investment decisions were primarily based on subjective judgment and intuition rather than rigorous analysis. Markowitz sought to bring more scientific rigor to portfolio management by integrating concepts from mathematics and statistics. His groundbreaking research was first published in a 1952 article titled Portfolio Selection in the Journal of Finance. Markowitz's key insight was that an investor's risk and return objectives should not be analyzed solely at the level of individual assets, but rather at the portfolio level. He argued that by combining different assets with varying risk and return characteristics, it is possible to achieve a more optimal balance between risk and return. Markowitz introduced the concept of diversification as a means to reduce risk. He demonstrated that by selecting assets that have low or negative correlations with each other, investors can effectively reduce the overall risk of a portfolio. This concept challenged the traditional approach of investing in a few individual stocks or bonds and highlighted the benefits of spreading investments across multiple asset classes. To quantify the risk and return characteristics of assets, Markowitz introduced statistical measures such as expected returns, standard deviations, correlations, and variances. He developed mathematical models to calculate these measures and used them to derive optimal portfolios that offer the highest return for a given level of risk or the lowest risk for a given return. Markowitz's work gained widespread recognition, and in 1990, he was awarded the Nobel Prize in Economic Sciences for his contributions to portfolio theory. His research laid the foundation for MPT and provided a framework for understanding risk and return trade-offs in investment portfolios. Since Markowitz's initial work, MPT has continued to evolve. Researchers have expanded upon his ideas and introduced new techniques and refinements. For example, William F. Sharpe developed the Capital Asset Pricing Model, CAPM, which extends MPT by introducing the concept of systematic risk and the relationship between an asset's expected return and its beta. Furthermore, advancements in computing power and data availability have allowed for more sophisticated applications of MPT. Portfolio optimization algorithms and risk management tools have become more advanced, enabling investors to construct and manage portfolios with greater precision. Overall, the historical context and development of MPT can be seen as a response to the need for a more systematic and scientific approach to portfolio management. Markowitz's pioneering work laid the groundwork for a quantitative framework that continues to be a fundamental tool for investors and has had a profound impact on the field of finance.